Okay, we're going to begin. Good morning, everybody. My name is Richard Joy. I'm the Executive Director of ULI Toronto, and on behalf of my chair, Salima Rawji, who you'll be hearing from later in the program, and our management committee, we welcome you to this, our 20th anniversary Urban Land Institute Annual Trends Program, building on the cornerstone PwC Canada Emerging Trends in Real Estate presentation and panel event. There could be little doubt that this report lands at a most challenging time for real estate and development across Canada in most asset classes and geographies. And perhaps for the wrong reasons, it's against this backdrop that the 2025 Emerging Trends in Real Estate report and this morning's annual Trends in Real Estate program are especially relevant and I hope valuable to you as we chart our course through uncertain waters. We always begin with a land acknowledgement, but in lieu of reading that land acknowledgement today, I'm going to briefly speak to how we're putting some real meaning, we think, behind these words, this statement, as we explore truth and reconciliation at the intersection of real estate and development. For several years, ULI has worked with a cohort of industry leaders along with our partner Shared Path to navigate this space. We've produced numerous educational programs that you can find easily online on our website. We have showcased real estate companies who are developing their own truth and reconciliation strategies, as well as spotlighting Indigenous leadership industry and our talent in our industry. This past fall, we hosted a sold-out Indigenous cultural competency course, and we'll be reconvening that course for your companies and your employees in the coming new year, and we recommend it very highly. And just yesterday, we hosted Councillor Larry Salt, former Chief and Grand Chief, who represented the recently elected Chief and Council of the Mississaugas of the Credit First Nations at a special members-only event at Aird and Barreless. Our journey in Truth and Reconciliation only has just begun, but we invite you all to join us for what is proving to be a very valuable and meaningful pursuit. Before I introduce our first speaker, I'd, of course, like to acknowledge our many table sponsors in this room who have made this year's in-person event possible with your generous support. And there was a moment, I can assure you, when we weren't sure if this was going to be possible this year. So we're just so absolutely thankful for that support. You'll find those sponsors on your program, on the back of your program, as well as the table signs around the room. But to all of our sponsors, we say thank you. As mentioned, we have a very packed program for you this morning, so I'm going to turn quickly to our first speaker, Robert Hogue, Assistant Chief Economist at RBC, who we've asked to provide us with a brief level set of the broader economic context, the shifting economic context onto which this discussion this morning will be taking place. Obviously, this context, as mentioned, is very fluid with all the global events at play at the end of 2024. In bringing Robert to the program, I will note that his and all our speaker bios can be found on the QR code on your program, so you can easily grab that because at ULI we're sort of notorious for skimpy introductions, and in that fine tradition, Robert, we'll invite you up to the podium. Thank you.
Wow, real estate, I thought it was a Taylor Swift kickoff party, so sorry, I prepared for something else this morning. And speaking of Americans, I think a week ago we got some clear results, and actually I was speaking with someone before. I didn't expect to have some clear results like so soon. Some reason I thought it will take weeks and weeks to sort out the political situation in the U.S., but here we are today with a very clear mandate for Donald Trump, for Trump 2.0, and quite potentially a red sweep of all the powers in Washington. So clearly we are in for quite possibly a very bumpy ride over the next few years. It may obviously have some repercussions for Canada's economy and for us Canadians. but it might, if it gets the U.S. economy going on as stock market seems to be reacting to lately, if the U.S. economy goes well, it could have quite potentially some good implications for us as well. The U.S. being our biggest trading partner. Now, but that being said, I think that the period ahead, we have to prepare and to be ready for quite a bit of uncertainty, some potential volatility in terms of policy, in terms of risk for us here in Canada. And for us at RBC Economics, we're still sort of juggling with all those possible scenarios. So we haven't necessarily landed on something at this point. We're waiting to see what will be implemented and operationalized over the coming over the coming weeks and months to get a sense of how it's going to really affect us in Canada. But if there's let me maybe just point to something that has not been really talked about in the election campaign in the U.S. is for all the promises on both sides, there has not been really much mention about the implication for the fiscal situation in the U.S., where the deficit is already gigantic, by the way. And a good part of why the U.S. economy is surprising us at every kind of new economic indicator we're getting, resilient, very resilient, very, still a lot of momentum at this stage of the cycle. But a big part of that it is because the U.S. economy, the U.S. government, the federal government has a very, what we call fiscally stimulative expansionary policy, which gets, when the government spends a lot more than it receives in revenues, it is, really gets the economy going with all the spending or tax cuts. But that non-issue in terms of talking points may come home to roost at some point. And this is just something I want to plan out there, that not necessarily there's around the corner some kind of major factor that's going to hit the U.S. economy, U.S. government, but certainly at some point these large deficits, which are leading to very high debt as measured by as a share of GDP, as a size relative to the size of the U.S. economy, it may have some implications on how quick and how much Donald Trump and his team will be able to implement some of their programs. Think of tax cuts, for example, but there could be some other measures as well. So financial markets, in a way, at some point might just kind of step in and say, look, okay, fine, you've got a very ambitious program, but you as a government are becoming more riskier, and we demand higher risk premium for all this debt you're running. So just to plan it out there, at some point there might be a little bit of resistance towards that, and may have also implications. I'm going to turn and talk about interest rate in a minute, but at the long end of the yield curve, that we might not, if we're thinking that interest rates are going down, there might be some resistance at that end as well. We've seen 10-year bonds and, for example, coming down to, well, actually more recently, in more recent weeks and months, we've seen them backing up again, and that may be part of that sort of financial market reactions to what is in place now, but which may be coming as well. So that's just the kind of planning out there, keep that in mind. But turning to the good news is inflation, the fight against inflation is actually, in our book, it's won. The Bank of Canada, Federal Reserves are probably not using those words, but with an inflation rate of 1.6% as of September here in Canada, in our forecast, according to our model, probably inflation is going to stay below 2% over the next year. So the work is done. We're there. This is where the Bank of Canada wanted to be. Actually, we're probably a little bit below. The Bank of Canada was targeting 2%. So in effect, the pivot that we saw in June here in Canada by the Bank of Canada is absolutely, totally appropriate. If anything, we're going to look back, we're going to probably say, well, it could have started to cut cut a little earlier. And the fact that now it's accelerating the pace of rate cuts is absolutely appropriate. And there's no reason in our book that interest rate, like the policy rate in Canada, should be in restrictive territory. Now, currently, the overnight rate, so the policy rate in Canada is at 3.75%, and the Bank of Canada considers a neutral rate being somewhere between 2.25% and 3.25%. So we're above that, meaning we're in, like, we have a restrictive monetary policy at the time when inflation now is below the 2% target, and Canada's economy is weak. So we fully expect the Bank of Canada to continue to aggressively cut rates. We're expecting a 50 basis point cut in December, and then 5 further quarter-point cuts in 2025 in successive meetings. So our call is that the Bank of Canada rate will hit 2% by around the middle of next year, which is maybe at the lower end of the consensus rate now. But our view is that, like, since the fight against inflation is won, there's no reason that the overnight rate should be this high. Now, as I mentioned, at the long end of the curve, however, there's a lot less room for bond yields to come down. So longer-term interest rates will, our view, still going to come down, whereas we think there's another 1.75% to come down from current levels for the overnight rate. But we're expecting the 10-year bond yields there's roughly maybe another 70 basis point to come down, and then probably going to stay around there. There might be some upside, depending on what happens south of the border. There might be some upside risk to that call. So yes, longer end, further cuts, but not quite as much. And obviously, what I didn't mention is that we expect the Fed to be less aggressive on rate cuts. We've seen a big 50 rate cut to begin, and the Fed was a little bit behind other central banks. But our view is that the Fed has 2 more rate cuts to go, and then it's going to keep it at just over 4% in U.S. So that's this kind of divergence in monetary policy, which is, we've seen this in the past. Typically, the Bank of Canada and the Fed are move in tandem. But there's been some time in history where there's been some divergence. So we expect that a certain degree of divergence for a little bit of time going forward, and this will put, and we've already seen some downward pressure on the currency. So we do expect the Bank of Canada will remain under downward pressure over the next 6 months or so. It might dip below the 70 cents mark between now and the middle of next year. But a lot of the downward pressure, a lot of the discrepancy and divergence in monetary policy has already been priced in. We've seen the Canadian dollar weaken over the last little bit. So when we think, well, the fight against inflation is one. What the Bank of Canada was attempting to do deliberately, what the design of jacking up interest rates so much so quickly, was to cool down the economy. And it worked. When you look at GDP on a per capita basis, it's been declining in 7 of the last 8 quarters. So essentially on that basis, Canada's been, let's call it, in recessionary conditions over the last 2 years. So monetary policy has worked. And so the economy is soft, it's weak. Things are we're not doing that well. When you look at other indicators like the unemployment rate, for example, it's been drifting higher, not tremendously higher, but it's been drifting higher. Now we're around 6.5%, which were sort of the normal or the neutral level of unemployment rate in Canada is around 6%. So we're starting to see a little bit of slack building, not in every sector or any occupation, but generally speaking, there's a bit of slack starting to build, especially for the young people and new graduates and newcomers to Canada. We've seen their unemployment rate rise a lot more. But overall, there are some signs of weakness. Now, officially, Canada's economy is not in a recession. The numbers, the GDP numbers, the aggregate numbers say that we came very close last year. And overall economy, we can consider it as being stagnant. We've seen a little bit of an uptick in economic growth in the first half of this year, but still below Canada's potential growth rate. So it's still kind of, things are still slow. We're starting to pick up, but still kind of slow. And the only reason that Canada's economy did not tip into a recession is because we've had tremendous growth in the population, and entirely fueled by immigration. I'm not telling you something you don't know. I think if anybody's been reading the news over the past at least year will know that. And with a population growing at around 3%, just above 3% in Canada, that's something we had not seen in 6 decades. In absolute numbers of 1.2 to 1.3 million increase in Canadians, that's something we've never seen in Canada. So it did help the economy get through this soft patch, avoid a recession, but at the same time it created a lot of pressures, tensions on infrastructure, be it like schools or hospitals, but obviously housing has been top of mind as well. Not that this wave of immigrants that we've had over the last few years were the source of the housing crisis, but clearly contributed and probably magnified that crisis, especially on the rental side. So clearly this has been a two-sided issue. The thing is, this kind of tailwind that we've had from immigration is about to shift. About 3 weeks ago now, 2 or 3 weeks ago, the federal immigration minister announced new immigration targets, and they are quite considerably lower than they were before, especially on the permanent resident targets. They've been reduced quite considerably for the next year and the year after, but I would point out, so we had 500,000, that was the previous targets. Now it's under 400,000 for the next 3 years. So I would say fairly sizable cuts, but the more dramatic one is on the non-permanent side, where the net flow of non-permanent residents, think of international students and temporary foreign workers, for example, added 800,000, last year 800,000 to the population. And under the new targets set by the Minister of Immigration, they will subtract 900,000 over 2 years, because the federal government now is targeting a non-permanent resident of 5% as total population over a 2-year period. The starting point is 7.3%. So when you work out the math, it means it represents a significant drop in the flow of non-permanent residents. So this is going to take probably the demographics picture from a tailwind to a headwind over the coming years. So the way to keep growth in Canada going, and it explains for those who've heard a lot about productivity lately, it is now to maintain the growth in the economy. It has to come very primarily from productivity, labor productivity growth. Unfortunately, Canada's performance on that front has been far from stellar over the last a few years, especially the last 3 years. So we've got a lot of work to do on that front to maintain Canada's economic momentum going forward, or even increase it. So we're quite hopeful that lower interest rate will help a lot, but keeping in mind that the demographic factors will be a headwind going forward and not a tailwind. So our view is that, now to try to finish off on kind of putting it in terms of the housing market, is something I cover quite closely for RBC, is that we've seen now this recovery that's been sort of pretty slow over the past year or so. Home resale activities picking up. Now we're starting to see, like in October, the numbers are starting to look a little stronger, and we're expecting that recovery to continue in the period ahead over the coming year. Now, with interest rates having the cumulative drop in interest rate will help more and more, so we're likely to see a little bit more of a buildup in that momentum. But as far as, so we're expecting probably by 2025, we'll be back to levels that were that prevailed before the pandemic. We're not talking about the crazy levels that we had in the early part of the pandemic, but certainly we're on track to be back to where we were in 2019, somewhere around there. We're not expecting major upward price pressure, and in that context, what we have in Canada is still a huge affordability problem. This is going to be a major constraint for many buyers to the bid up prices. So in the context or in the situation here in Toronto, in the Toronto area, we still have a lot of inventory to clear on the condos, a lot of new completions that came to market in recent months. So we're not expecting price pressure to build significantly. We're quite possibly are looking at a very diverse set of outcomes across Canada. But overall, kind of prices, yes, increasing, but still modestly at first, because affordability is such an issue and is unlikely to be resolved in very short order. There's a lot of people here in the room has participated in the discussion and advice to policymakers. And I encourage you to continue because it has to be an all hands on deck kind of approach. There's been some good progress from a policy perspective, but we need to operationalize that advice and make sure that we build a lot more, because ultimately it's a big supply problem. We need to, especially in the context where demand is going to start rising, we need to have the supply responding more quickly, and especially at the more affordable end of the spectrum. So this is the quick run through of how we see things going, especially with the interest rates. And I'll turn it back over to you, Richard, for the rest of the program. Thank you.
Thank you, Robert. We gave you a tough assignment to try to do all that in about 15 minutes. That was unfair of us, but you did a great job, so much appreciated. We're now turning to our feature presentation of the annual trends report, powered by PwC, Canada's ULI partner, in delivering the chapter of this esteemed. It's actually over 40-year plus report. And about 20 of those years, we've had the Canadian chapter, so about half of its life has included this featured Canadian lens. And Frank, I believe this, I don't know if this, am I letting a secret out if I pass on the fact that this is you'll be your swan song presentation of the report as you head towards retirement. So I'm just thrilled that we can get you to do this one final time. And this time we're going to do this. We're going to do something special for you. We're actually going to make these comfort monitors work for you, because in the past no one knew this, but Frank was flying blind a few times because of technology. But touch wood or plastic that this will work this year. But Frank, over to you.
So, first of all, I just wanted to say welcome, everyone, to the ULI Emerging Trends in Real Estate launch event. It's actually the 46th year of this publication, the longest standing publication out there dealing with real estate. And I'm really, really excited to be here. And, we have a barometer on how real estate is feeling. But when I walked into this room feeling the buzz, I got a sense also, another data point on how people are thinking real estate is looking going forward. So I'm really excited to be here and really share the results of what we heard this year. Just for some background in terms of how this was developed, we interviewed over 450 senior C-suite executives from across Canada, across North America, of which 200 were here in Canada. And we also had 1,600 surveys that were sent out to all real estate professionals that cover all asset classes and everything that touched real estate. Now, what's really important for you to understand is that the sentiment and how we were informed by this report actually took place during June through August 2024. And as we all know, quite a bit has changed since then. We now have a Trump administration. We have seen interest rates come down. And as Robert said, a massive change to the immigration policy. So a lot of stuff has happened that really has impacted, and we've heard in subsequent conversations, the sentiment start to change. But I would like to take a moment to actually thank all the voices that informed our report this year, many of whom are actually in this room tonight. And their names are actually printed digitally on the report in the back. And, I ask you to just take a look. And if you take a look at the people that we talk to, if those people can't tell you what's going on in real estate, I'm not sure who can. So why don't we get started? Now, before we talk about the trends of 2025, what I like to think about is let's spend some time on what we saw last year and what did we hear. And actually, what we heard last year was really about a Canadian real estate market that was shaped by 4 main issues. It was geopolitical uncertainty. It was the rising interest rates. It was the high inflation. And it was really a period of price discovery where deals were pretty much just stalled. Nothing was really happening. And the geopolitical uncertainty that was out there, it really led a lot of caution among foreign investors. The rising interest rates that we saw really cooled buyer demand, and then it really slowed a lot of the development activity that we saw. Inflation drove up construction costs and really fueled and exacerbated the affordability issue that Robert talked about. And it really created a big challenge in our market. Now, together, what happened, all of these factors really made asset valuation much more difficult, which really led to this period of price discovery, where things were pretty much locked. So, what did we hear this year? Was it any different? Not really. It was a lot of the same. And it was interesting when we talked to individuals, there was a pretty mixed outlook, and it really depended who you spoke to. Some would say, things just can't get any worse. Now remember, this was June through August. But others, they felt that, hey, this business, there's no better business to be in than this one right here. And what we saw was really a widening gap in outlook that was really shaped by the region you were in. It was shaped by the asset class you were talking about. And it was really about also the different investment strategies of the people that we talked about. Now, this year, what we really heard about is a real estate market that is really continuing to grapple with really significant capital constraints, making deal-making really challenging as investors really started to navigate the interest rates. Now, recently, they've come down, so things have got a little bit better. Albeit, even though those rates came down, there was still a lot of uncertainty. These constraints have led really to a cautious approach by many of the investors and developers that we talked about. Many really opting to delay some of their investments or even sometimes reconsider some of their investment strategies. Now, the affordability crisis remains one of the biggest and most pressing issues. And I think it's been further exacerbated by the frozen condo market, which we'll talk about shortly, that left many potential buyers and investors pretty much sidelined. Now, this complex landscape really has created a paradox in my mind because I think there's a ton of opportunities of growth that exists, but yet the economic realities and the regulations really seem to make it really hard for you to reap the reward. Yet, despite these hurdles that we've seen, what we did hear, albeit, was a little bit of optimism, and sometimes it was difficult to find, but there were pockets of it there. Now, every year I like to present the Emerging Trends Barometer to provide a sense of what is that real estate sentiment. And this year, it is demonstrating, as I talked about, a pretty mixed outlook. The data for people wanting to buy, sell, or hold pretty much all kind of converge or were very close to that fair area, telling us that people are actually quite uncertain about the outlook for real estate going forward. Investors are much more likely to be selective and focus on the opportunities that really are going to offer them that best opportunity for returns, while really managing the market risk that was out there. Now, we asked all our interviewees what were the most important issues for real estate in 2025. And I guess, it wasn't a surprise that the top economic, social, and development issues were pretty consistent with 2024. But I did want to highlight a couple of things that kind of came up to the top that were slightly different than last year when we talked to these interviewees. The first was all about government alignment and the related issues that, interestingly, have really kind of percolated to the top, issues on both the social and development side. You know, this was cited time and time again when we spoke to our interviewees. Now, infrastructure and transportation was a new addition in 2024. And standing here, talking to a bunch of Torontonians, I don't have to tell you how important infrastructure and transportation is for creating an environment that's conducive to investment and development in real estate. And then qualified labor, that was another topic that emerged as a top economic issue this year, rising from third place that we had it last year to right to the top. And with the recent federal immigration cap, you know, I think that this is just going to get amplified going forward. So what were the topics that we consistently chatted about this year during our interviews? Well, all sorts of stuff. It was about naturally housing affordability. Lots of solutions, no answers. It was about industrial asset class. It was about niche classes like senior housing. It was also a lot of conversation about the office boom. Office boom in the sense that what's happening with the new hybrid policy. And data centers, data centers, data centers. Lots and lots of conversation. But I think when you cut through all of this, many believe that there was a new real estate cycle that was going to begin. Now, with capital markets starting to recover, inflation and interest rates, you know, trending down, and finding that the bid-ask on assets were starting to narrow a little bit, I think investors and developers were encouraged to get off that sideline that they were there last year. And so all of these topics that we talked about really formed the key issues and set up our key trends for 2020-25. So what were they? So what were these key trends that you told us about real estate? And we tried to synthesize them into three. And so the first is really about the focus on the ability to unlock value amid deal and capital constraints. With interest rates, when we had this interview, relatively high but coming down, investors were becoming more and more selective in prioritizing opportunities that really promise strong fundamentals and really a clear path to value creation. So for sure. Second, it's no surprise that housing affordability continues to remain an absolute critical issue. And while I think if you were here last year, I expressed some optimism that the potential solutions that we have from both government and developers were going to help address this affordability crisis, the reality is it's becoming increasingly difficult to realize. The gap between supply and demand just continues to widen, and without swift, not Taylor Swift, but swift decisive action, I think the dream of affordable housing for Canadians is really going to be that, just a dream. And, you know, I started to, when I was preparing for this, I thought about, now what's this new immigration policy going to do? Is that going to be that swift action that actually might help this in a more meaningful way? I guess time will tell. And finally, our last trend that we heard, which was quite interesting, was all about building a sustainable and climate-resilient strategy for the future. You know, we've seen a lot of extreme weather conditions, changing investor expectations, increasing government regulations as well, and shifting consumer behaviors. All are really compounding factors that are really bringing ESG to the forefront, and it was quite clear in the conversations that we had. So now, why don't we just double-click a little bit on some of these key trends to just talk a little bit more about what we heard. And we'll start with deals and capital constraints. Now, we identified a number of what I'd say emerging trends that we believe are really going to shape the future of the deals market in 2025. In 2025, private investors, especially family offices and private equity funds, we believe are going to emerge as the most active buyers, filling the gap that really have been left by pension funds and by insurers and the REITs. And with the shrinking domestic pool, foreign investment opportunities are actually expanding, especially coming out of the US and Western Europe. And Stats Canada reported that actually foreign direct investment in Canada has increased by about 15% most recently. And many interviewees actually also talked to us about really strengthening their balance sheet, damming up the cash, clearing their operating lines. Why? Because they're positioning themselves what they believe are to acquire properties and take advantage from some highly leveraged real estate developers. And finally, one of the other items that we heard is about the conviction-led buyers. And they're really starting to target more thematic investments, always in the industrial and purpose and multifamily properties, because they seem that these asset classes are probably the strongest bets. But we also heard, additionally, that there's been increased investment in the alternative asset classes. Now, with relatively few core audit, industrial and retail properties on the market, and limited opportunities really for a significant uptick in yield, some real estate investors are really taking a closer look at real assets, something that tends to blur the lines between real estate and infrastructure. And there's been a growing need for data centers, and we heard a lot of conversations about data centers. And maybe it's probably driven by that, the fact that we've got this emerging trend like generative AI and cloud computing and all the Internet of Things that are just going to require a significant amount of computer power, and therefore these data centers in order to house them. Now, also shifting consumer behaviors and the growing population are really starting to create increased demand for cold storage facility. And so that was another area when we were talking to investors that seemed to kind of pique the interest. And then finally, it was student housing partnerships was another conversation that we had. Some argue that investors haven't really scaled the Canadian student housing sector to the same degree that we see around the world. Now, we also ask our interviewees each and every single year about the availability of capital. And while the investees still believe that debt and equity capital will be undersupplied, the trend suggests that Canadian real estate market will actually experience an improved access to capital in 2025. Now, this improvement in capital availability can lead to increased investment opportunities and development activities, we believe, across the sector. However, we also heard that the market is still facing some challenges, and a significant portion of the market is really still expected to be a little undersupplied, really highlighting the need for much more partnerships amongst real estate organizations and really some innovative financing. Now, we have to talk about the condo market, and that was something we spoke about quite a bit, and especially here in Toronto and Vancouver, which for all intents and purposes is largely frozen, with prices stagnating and even declining, rental rates actually softening. The high rates are really suppressing demand and causing really a lot of investors and buyers to hold off as they kind of wait for either further price reductions or continued lowering of borrowing costs. And reports have indicated, and we've been watching this quite closely, that there's a growing number of pre-construction buyers that are pursuing assignment sales. That was quite interesting, which is leading really to a substantial inventory of unsold units and really making it unfeasible for many developers to really launch any new condo developments. Now, interestingly, while we're witnessing fewer receiverships and distressed sales than expected, because when we talked to people, they thought there'd be a lot more, many that we spoke to actually are predicting a pretty big uptick in this situation come 2025. However, many believe that the condo market, long-term, will eventually recover because of the just basic demographics. The question, though, is how and what kind of impact will this immigration policy have on this sentiment, where I guess population growth, according to Robert, is expected to be flat over the next couple of years. Now, the second issue that we wanted to touch on is tackling affordability crisis. And you're going to probably say, this sounds like a broken record. We talked about this last year. Well, it's because it's still a significant issue, top of mind from everyone that we spoke to. Housing affordability is critical in Canada, and the costs of buying and renting are just reaching unsustainable levels for many Canadians. And while governments have announced measures, as Robert mentioned, at increasing supply, industry players believe that more comprehensive efforts, when we spoke to them, are really needed to tackle this complex challenge. You know, we're constantly facing supply barriers, including lengthy and complicated approval processes. I can't tell you how many times I heard that in the interviews. There's a shortage of qualified labor. You know, we heard they don't have enough, bricklayers, they don't have enough carpenters. Like, that's a constant issue. And a lot of competition now is taking some of the remaining workers onto public infrastructure projects. These factors are all contributing to rising costs and really making it difficult to build new housing in an affordable way. Now, on a positive note, the federal and provincial governments have made some policy changes, like waiving GST on purpose-built rentals, and making strides on closing that affordability gap a little bit. However, the implementation of these measures that have been done to date are slow, and their overall impact really hasn't made a significant difference to date. Now, last year, it felt like there was hope surrounding the affordability issue, but I'm not sure 1 year later, today, that really any real meaningful progress has happened. So it really begs the question, what is the solution to this crisis? And we talked about this last year because nothing's changed from that perspective. And we heard it again and again when we spoke to interviewees this year. And it shouldn't be a surprise that we need an alignment and really coordinated response by all levels of government, not just the federal doing one thing and provincial another. It's important that they're all aligned, working together with developers to really find solutions. And one of the constant things that we always heard is that we often find that the different levels of government and their regulation and their policies actually don't work very well together. And that's part of the problem. Second, it doesn't really matter if we got alignment. That's great, we've got alignment. But then we don't have people to actually deliver. So we can't forget this affordability issue is driven in part also because we just don't have the people or the labor to help. And whether it's going to be through targeted immigration or just development of skills as college, we have to really address this issue because if we don't, we're going to have problems for a long, long time. Third item that we heard is that we really need access to some cheaper capital. We heard that there's a lot of what I'd call equity capital available, but they do need that cheaper capital to really make some of this projects viable. And that's something that CMHC can actually step in and do something about it. And finally, I'd be remiss if I didn't talk about something that we heard from many developers that we talked about, is that we really need more innovation in the entire industry by all stakeholders to really drive more efficient supply. And so whether it's new ownership models, new financing models, or better building methods, and even just consistent building codes amongst the different municipalities that don't really add unnecessary costs. In short, we just need much more coordinated innovation. Now, of course, this wouldn't be a trends report if we didn't talk about technology, and especially with the new kid on the block being generative AI. So we asked many of our interviewees, what they thought about generative AI. And, I think it's interesting that there's been some strides in terms of this sector leveraging some of the technology. But for many, generative AI has really just piqued their interest at this stage, with many actually moving quite cautiously. But this isn't to say that Gen AI and AI, for that matter, haven't been effectively adopted by some of the Canadian real estate companies we spoke to. We saw many interviewees that were using some pretty innovative ways to leverage the technology, from data and analytics to analyze market trends, to automating routine tasks, enhancing customer experience through kind of personalized chatbots. We are seeing a lot of this happening, but the progress is actually quite slow. And my message, in terms of what I heard, is we better get on this bandwagon because this is a new, disruptive, and transformative technology that will undoubtedly, and I say that undoubtedly, have a significant impact on our industry and your business. Now, shifting a little bit, there's what I call a jarring stat that I came across when a recent PwC report came out, and that was that 81% of Canadian companies have yet to quantify their climate-related costs and risks. And today, when we spoke to individuals, we saw a pretty big divide amongst Canadian real estate companies, from those that just see this as just a compliance exercise, tick the box, to others that actually saw and recognized that decarbonization as really a crucial strategy of reducing risk and in their decision-making to really preserve the value of their assets. So we've seen extreme weather events. They're becoming much more frequent. And this year truly highlighted that reality. In fact, our office had to evacuate because of that. Now, this shifting landscape has really made it clear that strengthening your climate risk strategy isn't just about compliance, if that's how you think about it. It's now about competitive advantage for both the buyer, investors, and lenders alike. So for those that are looking also to tap into institutional capital, environmental performance and disclosure are critical. Banks and large institutions now are really, including pension funds, are now focused on quantifying their greenhouse gas emissions associated with the capital that they're actually deploying. So many have set some ambitious targets, and they're pretty keen on financing companies that'll help them get there quicker. And often, we're seeing some favorable terms. Actually, I was involved in a recent offering, and they were told that they got up to 40 basis point improvement for that, for their ESG program. Now, as we navigate through these rapidly evolving trends in climate resilience and ESG strategy within real estate, I think it's going to be important, or actually crucial, that we take action now for success, because that window of opportunity will close quite quickly. Now, quickly, just want to go over some of the different property types. So this is part of the fun part. I love asking individuals, what do they think about the different property types? So we'll quickly go through those. So first up is industrial. It continues to remain quite healthy, although we're seeing the shine come off a little bit, given we're coming off a very, very hot period of activity in industrial. What we did here, though, is kind of almost a pivot a little bit towards the niche asset story. So there was like a growing demand and conversation around data centers, cold storage assets, as I mentioned. Also, a lot of the real estate players were adapting to some of these, what I'd call softening conditions, by focusing more on build to suit developments as opposed to spec building, and actually focusing on smaller projects for multiple tenants as opposed to really relying on those big tenants like Amazon. Purpose-built renting is one of our big bets and top investment choices in 2025, what we heard. And again, the rising demand for student accommodations and senior rentals, combined with rising rents, it really has enhanced the prospects for purpose-built rentals. And this has been somewhat bolstered by CMHC financing and some of the tax incentives that have been put in place. And on a report when we were doing part of this research, we found is that CMHC actually anticipates that purpose-built rentals completions are actually going to remain, though, quite tight. Now, we had a lot of conversation about the future of office and retail, but I think generally what I'd say compared to last year, even brighter. So let's start with retail. Retail was a really strong asset class last year, if you recall. There was a lot of people looking to it, and I think that has continued, that turnaround. We're seeing a lot more foot traffic that was recovering. Consumers are returning to the physical stores, and I think a lot of the predictions about the fact that there's going to be a permanent shift to online shopping, were quite exaggerated. So, I think this asset was one that was actually quite embraced by the communities. As you can see, that it made it up into our top list of investments. As for office, I think the whole conversation about hybrid work has kind of settled down, and what we took away from this is that, yes, we're now at a more elevated level of vacancy that we've seen across, but we've seen a much bigger bifurcation. So the Class A, highly amenitized office is actually doing quite well, whereas some of the suburbans are much, much more challenged. Now, condominium, we spoke about this. The condo market is struggling right now, and it's just due to the high interest rates and increased construction costs. It's really led to a slowdown in this whole area, especially in Toronto and Vancouver. I was out in Vancouver actually last week, asked that question to see if anything's changed. Pretty much still dead. Developers are really facing a lot of challenges with pre-sales and unsold inventory, which is really causing a pause on any new ideas of new projects coming on stream. And then investors who actually make up a large portion of the new condo buyers are really pulling back just due to the high interest rates, and they're just finding other areas to put their money right now. And not to mention that there's the gap between new sales and resales is quite big, and so that's also depressing a lot of activity that we're seeing. So we think this market, based on what we heard, is going to continue to be in the pause up until into 2022, potentially creating an even greater shortage in subsequent years. Now, single-family housing, the biggest issue facing single-family housing is really affordability. And we're now, an even greater significant portion of household income is required to just cover the ownership costs, and Robert showed that chart, especially in Vancouver and Toronto. And despite these affordability challenges, though, we did see actually an 8% increase in single-family housing starts for the first half of 2024 in Canada's largest metropolitan areas. But one of the new trends when we were talking to developers in terms of single-family housing, it was interesting that there was much more focus around multi-generational homes or single-family homes that had rental options to really help and defray some of those home ownership costs. And then finally now, we come back to our best bets, something that we always do. We always ask our people, like, where are you going to put your money going forward? Which are the best markets for 2025? So first up in terms of markets to watch, big surprise, kind of, is Calgary. If you remember, a few years ago, Calgary was in the dumpster. Then all of a sudden it rose up to third, second, and now it was number one on our list in terms of markets to watch. It's really poised for exciting growth and opportunity. You know, I was out there last week as well to Calgary, and there was clearly a great vibe that was happening in that city. Calgary is followed by Vancouver and Toronto. And in terms of best bets, in terms of asset classes, no real change from last year. Number one and number two being purpose-built rental housing, industrial, we're at the top of the list for all the factors mentioned. However, like I mentioned, there's a lot of conversation around the niche assets, including data centers, student housing, cold storage, and even seniors housing. These segments really cater to specific demands, and they do present great opportunities going forward. And just with that, on behalf of my fellow PwC partners, I just wanted to thank all of you and all the interviewees that are in this room, because without your points of view, without your insights, there actually wouldn't be an ETRE. And hopefully you enjoyed the presentation and enjoy the rest of the program.
Frank, that was amazing. Thank you. I particularly amazing because I think when you all have a chance to tuck into the report, you will realize that this year Frank had an added challenge of bringing a really dynamic and exciting report together in a very compressed period of time. There's a lot more moving parts, I think, in this report than I would say I've seen in my 10 years of reading it. So it's a very, very, very worthwhile read. We're going to keep things rolling, and what we'll do now is I'll invite our panel to come up while I'm introducing you. So if you'd like to just make your way to the stage. This is what Blake Hutchison used to call our reactions and refutations panel. So you may hear some agreement to what you just heard in the report. You may hear some disagreement. This is an opportunity to get a little bit of real-time reaction to what we just heard. Moderating this panel again this year is Fred Cassano, who just speaks to the incredible depth of leadership at PwC Canada. Why don't you come on up, everybody, and we'll just get you sorted so we keep our time rolling here. And I will introduce those esteemed panelists as they are taking their seats. Veronica Magosano, Vice President of Development of Oxford Properties. Janet Chung, Director of Real Estate Investments at CPP Investments. Puyan Safapur, President of Devron Developments. And Peter Senst, President, Canadian Capital Markets National Investment Team of CBRE. A reminder to you all that the biographies of all our panelists, all our speakers, are found in the QR code in the program that you have in front of you. And a reminder to the panel that we record this program, so it'll be interesting to look back on your insights in a year or two, no pressure. So with that, Fred, I'll let you take it over.
So I'm going to start with market sentiment first, right? And I'm going to ask Peter, who has extensive industry experience on deals and advisory on, call it $150 billion of transactions over the years. So Peter, what's your mood? What's your view on market sentiment, and really, what does that mean for 2025 in terms of transaction volume?
I'm much happier to do a discussion like this year than I would have been last year. So clearly, sentiment is picking up. The industry itself is off the floor. We're off the mat. Things are going in a little bit more of a positive direction. And it's not like everything is perfect, but maybe just a couple of sound bites to share with you. I was in Asia last week. One of the stops was in Hong Kong. There was the ANREV conference. The audience was asked, do you expect to raise and deploy more money next year? 80% of the respondents was yes. Our U.S. debt capital markets business just had their biggest month since 2021.
Oh,
Was that a technology issue? Is that better? Can we hear that now? All right, I'll replay the tape. Replay the tape. All right, so confidence, sentiment, it's all going in a positive direction. I'm much more comfortable this time, this year, than I would have been last year. So the industry's coming off of the mat. We're getting better. I was in Asia last week, and one of the interesting sound bites from one of the stops in Hong Kong, at a conference called ANREV, the audience was polled. 80% said, we expect to raise and deploy more money next year. Our U.S. debt capital markets business just had their best month since 2021. So when I think about what we're doing in Canada now, in Canada, transaction volumes picking up, activity picking up, deal size growing. So we'll have roughly a $45 billion year in Canada trading this year. That's off of a peak of $62 billion in 2021. So yeah, let's say we're down 25%. Globally, that would have gone from 1.5 trillion to 700 billion. So that's down more like 55%. So within our CBRE world, we look good. Canada just looks different because we overperform at the bottom of the cycle. So we would be thought of as good beta bet. We don't overbuild, we don't overborrow the way that other countries do. So we do look positive. So I'm going into 2025 excited about most business lines. There are things that are still really challenged, as I mentioned, but generally the sentiment, the conversations I'm having, it just feels better.
well, that's very positive. And I'm going to turn it over to Veronica now, because Oxford has extensive portfolio of land and development. And you're actually involved in a large project, Square One, 18,000 residential units. So that's pretty fantastic, mixed use community. So we talk about catalyst moments, like interest rates, DC waivers. What's that done to your, call it, development strategy going forward?
Yes. First of all, I'm going to say I completely agree with the shifting sentiment, and I think probably many of us in this room feel a lot better today. Declining interest rates, great for the Canadian economy, really good for the real estate industry. So we're certainly moving in the right direction. And yes, Oxford has a very substantial development business. And maybe contrary to what many people in the room might think, we're actually quite busy right now, and we are getting set to put shovels in the ground on some pretty major Canadian projects in the next 2 years. So I think the question is, how are we making this happen? And I will say, yes, these catalyst moments are absolutely helping, but it's also about our conviction in the business and also just about the backing of OMERS and the strength that that brings. And so I want to dive in a little bit to the conviction, just to explain what I mean about that. Oxford has had a long history in development, and we've actually had a lot of success when we have started projects in slower cycles. So projects like Hudson Yards or Leadenhall in the UK, these were projects that we started in down markets, and they have actually performed very well for us. So we're not afraid to go first, and because of our track record, we have OMERS supporting us, they're supporting our long-term strategy. And so overall, when I look at these catalyst moments, what I would say is they're really important to help things happen faster, but they don't shift ultimately our long-term strategy.
That's two panelists with a wave of optimism, so that's fantastic. I think what we also heard in the report is it's very difficult sometimes to unlock value when there's not a lot of deals and capital at play, right? And certainly we've heard conviction. Some investors and interviewees last year told us quite convincingly that they were being more risk averse. But others saw opportunities because some of the pension funds were maybe decreasing their level of investment. So I'm going to turn to Janet. CPP investments, obviously there's a lot of discussion around, institutions reaching their real estate allocation in Canada. So just wondering, what's CPP's investments forward-looking view on Canada and your long-term, growth profile in terms of sustaining growth?
Yeah, I guess. Can you guys hear me? I guess I'll start off by saying the way that we invest. We look at everything on an evaluation of best risk-adjusted returns, and we look at that across asset classes, across the globe, within asset classes, within sectors, and it's a constant iterative process rather than allocations per se. It's not, we need this much of this, so deploy at all costs, this much of this, deploy at all costs. We were constantly looking at where's the market shifting, where can we best place our capital, and that's ultimately our mandate, is to generate the best risk-adjusted returns for the Canadian population. And so with that lens, I will say the fund is growing. Real estate will grow in commensurate with the fund. And we are still investing, we're deploying capital. Maybe our portfolio might look a little bit different than what we're used to. And that's really to adapt to what we see, how the world is changing, right? So we talked about data centers. Data centers is a part of that. Where do we see the world going? More online. And so there's tweaks and there's changes, and we're trying to adapt because ultimately we look for growth and value. But really, we still see lots of value in Canada. We see lots of value in the real estate sector.
Awesome. So we'll definitely come back to the data center question in a moment, because I will ask you on your $15 billion investment. So we'll come back to that in a second. But let's talk about, Frank said, you used the word frozen, the condo market. So call it limited capital. So I'm going to turn to Puyan, who leads Devron Developments, focused on sustainable products, sustainable architecture as well, livable communities. But we're experiencing challenges right now. So are there any innovative financing solutions that you're employing these days to really continue to deliver on your condo projects?
I'm afraid of kind of bursting the positive bubble. Everyone's talking about how things are getting better and we're on to better things. I think, and I subscribe to that thinking, especially long term. I think it's not a good idea to get too excited in highs and get too down on lows, and you should think more long term. But setting that aside, and also setting aside other sectors, focusing specifically on residential, and then within residential, focusing on condo. It's absolutely horrible. It's not good. It's not good at all. I mean, we had, in Q3, there's only 567 sales. For context, like the last time there was that few sales was early 1990s. And I think it's a bit concerning when sometimes we have highs and lows that are based on just market shifting, interest rates, et cetera. People talking about, oh, market sentiment generally about real estate or investing, et cetera, is getting better. Interest rates are going down. Condos are going to go back up. I think it's a huge misconception, and I think it's sort of really fundamentally missing the point that we actually have had a broken system of designing buildings, selling condos. It's just been very well cloaked in a really wonderfully excited investment sentiment and population growth that's continued to cover up the fact that the foundations were really poor and these stack of cards were just well protected, and now they're just finally fallen. I think we should be talking a lot more about why it was fundamentally broken and fixing it. And I'm not talking about small changes, major changes, because if we don't, at best, it is going to be extremely sluggish to expect condos to return back to any kind of pace. I think in the next couple of years, if you look at what's happening to completions, currently already, I think Frank mentioned, there's a decline in prices in reselling condos, and it's dragging down pre-construction pricing as well too. It's going to be a while before we're even that stabilized, let alone we are talking about growth. So. Not to sound overly negative and pessimistic, I actually think this is a really super positive thing that's happening for the condo-specific industry. You always kind of need to hit a wall so that you realize that you're going the wrong direction, so you can change direction. So I'm happy and would love to talk more about it, but I also don't want to. I'm happy to explore to the extent you guys want to take me.
Certainly, from an innovative financing structure, we saw Anthem go to market. Single-purpose, project-level financing, raising, I think, $82 million, 18% close. So that's the type of maybe innovation that we need at the condo level. Certainly, pre-construction sales is screaming business reinvention. So maybe share some insights on the innovative financing strategies.
Sorry, I realized I didn't answer your question. Okay, so the best innovative change I would love to see is for pre-construction financing and pre-construction sales to go away. I think one of the biggest reasons why we have condos that people don't like, which is not an opinion, there's lots of surveys, and we've conducted lots of surveys. There's third-party surveys that basically the actual general consumer sentiment towards condos in Toronto is quite poor. It's something like 90% of people feel like condos are not actually designed or built well. So, and one of the starting point of why we're here is because of pre-construction sales. Pre-construction sales encourages developers to need to sell to speculators, and speculators, as an investor, imagine when you go and look at a building that you want to live in. One of the first things you notice is, how long did it take me to get up this elevator to get to my unit? Did this corridor smell funny? Those are the first things you notice. But if you go to a sales office and you see investors, if they've been physically there in person buying, how many investor buyers do you think are asking how many elevators are in this building? How long is the elevator time? How is the corridors ventilated? And the answer is pretty close to zero. So our pre-construction setup has resulted in building condos that are further and further and further separated from what people actually want to live in. So that would be the best innovation if we could have it. And I'm trying to, and we're trying to see if we can have those conversations with bank lenders here. It might involve bringing lenders outside of Canada to pave the way to basically even just bring down thresholds to, even if you sold your 50% of your building, and the other 50% as a developer you had to keep. So you had to really think about, we need to make sure we build a product that in the end is actually attractive to the people who are actually going to come visit the building. We might build very different buildings. So, and we're seeing a little bit of those conversations. I think it's still early. I haven't seen anything major. The only thing that's helping for us as we're looking at our projects, I'm not sure if the word innovative would be exaggerating. It's just, I think right now lenders are scared to lend to a condo project. It's just full stop. The word condo right now is kind of a dirty word. I think the word condo hasn't particularly been positive for a long time, but it was because it was just making money. That was one positive thing with condos, but now that it's not doing that anymore either, now it's just a full stop negative word. So lenders right now are afraid of lending to condos unless you basically can demonstrate sales or getting to sales. But when you can demonstrate getting to sales, they will actually get very flexible because you will be one of the only files that they actually can lend to. So we're seeing in some lenders the threshold sensitivity or the coverage percentage for the loan coming down a little bit when you can actually demonstrate that between your location and your pricing, you can prove some success.
All right, well, thank you. I mean, more end user investors, but we'll come back to that in a second. Peter, from a commercial perspective, Frank talked about the differences regionally. What are you seeing across the country in terms of our biggest real estate cities, MTV, Montreal, Toronto, Vancouver, and Calgary, in terms of commercial activity?
Let me start. I'll go west to east. So in Vancouver now, we've come through a couple of challenging years. Vancouver is such a great market when you think about ocean, mountains, everything in between. It sort of protects everything beautifully. So a couple of slower years, as we felt the offshore capital pull back, it created a little bit of a void. That capital drove that market. We're now at a position where even in the last few months, that money's coming back slowly but surely. It's high net worth capital. Used to buy just land, now it's looking for income-based assets. So we will see Vancouver come back, but a lot of that's going to be mining, minerals, and that sort of side of the, sort of the economy coming back in. When we get to Alberta, it's been an extended tough period. So this has been one where we've watched it over and over. It's been tricky, but we're now just doing deals. We've just done a 1.4 million foot downtown office tower. So things are different, it's changing, it's palpable. So we're seeing groups looking for deep value within that office sector. But if you look at multifamily, if you look at retail and industrial, there's consistency. It's a good market. There's people really going into Alberta for value. So we like the prospects. We do believe Alberta in 2025, especially Calgary, will be strong. When you get to Toronto, roughly 50 cents of every investable dollar will end up here. It's sometimes even as high as 60%. But if you're coming here, you're looking for scale. You're looking for really just the bigger, more interesting deals. So we're really sort of leading coming out of this, where Toronto's seeing bigger money. It's showing up. It's feeling good. So I would say, by this time next year, we're going to feel even better about where we're at and what's going on. When you get to Montreal, it's a bit of a yield play from Toronto. So you want a little bit more alpha to go out to Montreal. This has been something where we haven't seen as much product so far this year, but it's been a consistent market. So we're relatively high on Montreal going into 2025. So coast to coast, if I leave out Halifax and Edmonton and Winnipeg, I would just say that we're going to have more stabilized years. You're going to see money come back in. Again, the idea of interest rates coming down means GICs are coming down. That capital has to find a home, and real estate as an asset class still looks good.
What's interesting is that you said office is trading in Calgary, and that's very positive because albeit it's probably at double-digit cap rates, but still, being purchased. I believe that was Oxford's sale to a private family in Halifax, which is interesting because there's confidence in Calgary, confidence in office, and just like our report says, the first movers will likely be private equity. So that's very positive here.
We did 12 office deals this year, which doesn't sound like a big number, but in the context of how tough the office market is, that's seismic. That you can really feel that, and it is setting up, sort of next year as there's a rotation within portfolios to find equity to step up and clean up that trade.
So in our second theme of tackling complex housing affordability, Frank mentioned looking at different business solutions or how to actually deliver in a different way using tech or other business processes. So Veronica, you're developing a lot of residential. Any innovative ways on process delivery or tech?
Yeah, definitely, and I will get there. I just want to say I feel like it is a hard market for all of us, so totally acknowledge that comment. And also, before I get into the processes, I think it's worthwhile to dig in a bit on the cost side of the equation and what's happening on that side of the ledger. Because I think everybody is very familiar with hard costs going up, and everybody knows since 2019, 45%. But there's some other things happening as well. And I think one of the things we're starting to notice, especially in cities like Toronto, is that many of the communities that we're developing in are at this inflection point where the public infrastructure needs to be expanded in order to keep up with the growth that we are anticipating. And in some cases, the developer is actually being asked to foot the bill for those expansion costs, even though it benefits more than just the single development. And ultimately, that ends up on the end user driving some of these affordability issues. And then also, to Frank's point on the time it takes for things to get approved, I know as an industry, we've all collectively really been trying to tackle this recently. I don't think we can take our foot off the pedal on this at all, and I think we need to really keep going, because when costs are accelerating at the pace that they're at, time is literally money now, and so we've got to be more efficient in how quickly we can get shovels in the ground. So I think I just wanted to set that context on the cost side first. And then in terms of the innovative processes that we are employing to manage all of that, we're taking advantage of financing opportunities, whether it be CMHC, or we also have the strength of the OMERS balance sheet where we can access corporate level debt, so that helps us on the financing side. On the process side, one of the advantages we have at Oxford is that we have a fully integrated design and construction team. And so whereas historically, I would say it was more the norm for development to design the building and then hand it over to the construction team to execute, now we are much more integrated from day one, really looking to find those efficiencies and understanding what those cost drivers are before we get too far down the path, because that just costs time and value engineering. And then it doesn't stop there for us. To your point on the end use and the customer, we are also vertically integrated across our leasing and operations team. And so right now in development, there's a lot of trade-off, there's a lot of choice needing to happen. And our leasing and our operations team, they always hold us accountable to what the customer wants. And so if we're having to make that decision between, a great design feature at the top of a building, a couple hundred meters up in the air, or a great amenity space, we're always going to pick with that customer in mind. And then the final thing, and this is very tactical and probably painfully obvious, but we are just being better at using the assets that we already own. So for example, at a lot of our mall sites where our purpose-built rental projects are going to take place, we have this enormous parking field already available to us. So we're looking to find ways where we can share, build less on-site parking, and that's the obvious part, right? Less on-site parking, less underground, costs less time, less risk, and then also just really better for the environment. So all of it is around improving our efficiencies and getting better and tighter at that.
And more end user.
And more end user. Yeah, always with a customer first.
So I think the other part of helping on the supply side is capital, and certainly CPP Investments has partnered with developers on several projects. So thank you for that, and hopefully that'll continue. And just on that point, will it? And is there a shift maybe towards condo to multifamily residential? Because we saw that in the interviews, a pivot to rental. So is that going to be a strategic shift for CPP?
I think at a broad level, housing in all forms, shapes, and sizes is a high conviction sector for us, Canada, globally. Within Canada, what we think, there's a unique proposition because it has a high quality of life, but one of the more, on a relative value basis, more pro-immigration policies. I mean, there's some changes around that, but all things considered, consistently in over a decade, it's been more pro-immigration. So all of that lends itself well to housing, and that's one of the areas we've spent the most time on, rental housing over the last, I would say, 5 to 10 years within Canada. I think the challenge for us right now is really the pro forma. And there's elements of the pro forma where cost is one part of it. The other is kind of regulation. I think housing is one of the sectors where it's more highly regulated than a lot of the other commercial ones. we're okay with that. We're comfortable with it as long as we understand it. And what we're facing now more recently is it's just changing so quickly and at the margins. And there's a lot of flux. When there's a lot of flux, it's really hard for us to underwrite with consistency and form a strategy and thesis. So sometimes I think the feedback is, if there's tweaks, and they could be positive, but on a net basis, constant tweaking could have a worse impact than just consistency and clarity in what certain regulations, what programs, et cetera, are really trying to solve.
Yeah, going back to alignment amongst all levels of government, absolutely. I want to go back to Puyan on affordability, because your goal is to produce high quality product, but how are you doing that in an affordable way? What's the trade-off between quality and affordability? How are you pulling that off?
This time I will remember your question. Can I just say one thing? Every time I hear the word end user, it makes me makes me chuckle and frustrated at the same time. We should not have a term end user when it comes to building condos. When you're developing a mall or developing offices or any other kind of real estate product, does anyone question whether we should design it for the end user or something else? It's always, of course, it's for the end user. You got to design, or if you're designing a table, a phone, a computer, you only think about the end user, and then you build a business and product backed on that. The fact that in a condo world, exclusively, we have a word end user, and we contemplate, should we focus on end user? And then the fact that actually it strikes fear in the hearts of most developers, the word end user, I think is a huge, huge red flag. So
thanks for pointing that out.
I think we should have only end user focus. So back to your question, to everyone's point here, it's hard to pull off any pro forma. And so that's one of the first things that everyone, as a developer, says, I can't even build like the cheapest building right now, and that pro forma, if you look at buying land right now, even though it's gone down a little bit, not enough, it needs to go down, I think, more. But even though it's gone down, even if it approaches to almost free, most pro formas don't underwrite, if you're really conservative or realistic on cost. So the question is, if a pro forma is hard to pull off for a typical building, how do you build a higher quality building, unless it ends up being like a luxury building, which isn't particularly helpful for kind of addressing housing for a large portion of people. The answer is, I can explain with a quick case study. So if you take a building, I don't know, say a 35-story building, and you do a typical condo as you've seen, glass building, jammed with small units, have like 400 units in it. And then if you take that same envelope and you create an end user building, and the first thing that'll happen is that the average size units will go up. Before doing anything else, once the average size units goes up, you have now less units in that same envelope. There'll be in a 38-story building, approximately in a case study, there'll be almost $20 million in savings just because of building less units. That's savings in DCs, that's savings in building less kitchens, less washrooms, less plumbing, electrical, potentially a little bit less parking, but even actually this assumption was actually without parking. So you can actually save $20 million by not jamming a building with small units, which now you can actually take that $20 million in a 38-story building. You can do quite a bit with $20 million. You can put a lot of that. You should need to put most of that back into the quality of the building, because that's another reason why the problem with our current condos is not just the size. It's everything, including the quality. So you got to put most of that back in, and you can actually take some of it to reduce the price point of the unit. So you can actually sell for less per square foot, and so basically side by side deliver a higher quality building with larger units, with a lower dollar per square foot compared to a typical building, typical condo, as you've been seeing. So I think that's probably the closest thing I can say to the word innovative. Again, the major innovation we need to make is that we need to stop questioning whether we should design condos for end users, i.e. for people. So I think that's the major first place we need to start.
Reconfiguring to get some savings. That's interesting. So maybe we'll come back to that, but I'm getting the warning already. So Peter, from a global perspective, how is the rest of the world looking at us from an affordability perspective, whether it's housing ownership or rental?
All right, so interesting question, very topical. So I spent a lot of time on the road. So I mentioned Asia. One of the bigger Asian developers said to me last week, it's really tough for us to look at how we underwrite in Canada now because you change too much and you change it too quickly. And it was one of those moments that you just felt that kind of comment. Another comment that came from another part of the world was, the most consistent thing within, this affordability is the most unaffordable cities are the ones with the longest time frames to get approvals. And obviously Toronto's right at the top. So you think Toronto, New York, London. So when you get big bureaucracy, too many levels of government, everybody combining, it gets tricky. So I think, my own take on affordability, if you taxed us a lot less, there'd be a lot more to pay for rent, for homes, everything else. So I think it's also a tax issue at the same time. So there's a lot of different ways to come at this one. The toughest part of our business is the land. Like trying to sell urban land for development, when you tie it all into affordability, that's the one area that has not come back. There's still pressure on land. So all of the complexities that we're talking about is just doing this to land value. So at the end of the day, until land gets down, hopefully it's not zero, like you mentioned, but I'm hoping there's going to be a level in between. Like we're getting selective land sites done, but again, this whole affordability, we need to get out of our own way. I think we're making this problem, more extreme and more difficult than it needs to be. But just if you taxed us less, that would take us a long way in a positive direction.
Thank you very much. There was a lot of discussion on climate, and I do want to spend some time on climate resilience because it's not only climate assessment, but it's also understanding the quantification of what it does to your real estate portfolio. Investors are taking discounts. If you're not taking action, to insurance premiums likely to go up if you don't take action, to increase disclosure. So lots of talk in our report about it, and certainly is going to be on top of the agenda in 2025. So Veronica, maybe you can share what Oxford's doing in terms of assessing climate risk and measuring it.
Yes, so climate risk at Oxford is broken down into two different buckets. We talk about decarbonization, and then we talk about physical climate risk as two separate items. So first on the decarbonization front, so the one thing that surprised me very much from the report is that there are still some sentiments out there that this is sort of a nice to have, a compliance, versus a must have. And what I will share is that at Oxford, we had a pretty major wake-up call at one of our large assets in Berlin recently, where we were in partnership discussions with Norges, and they actually challenged us on our decarbonization plan, and to the point where they said, without a costed and credible plan, they would not transact. So this is something that we do take quite seriously in all of our assets. And in the development world, we are challenged that if it's not going to be net zero from day one, we have to have that plan that tells us how we're going to get there in the short to medium term. So that's on the decarbonization front. And then on the physical climate risk side of things, OMERS in Oxford, they've invested in a tool that will screen our entire portfolio, and it will identify where there are physical climate risks to the specific assets. And I would say this happened really not a moment too soon for us, because you've all heard about the fires that happened this summer in Jasper, Alberta. And we actually own Jasper Park Lodge there. And it was because we had plans already that the teams were aware, and we had plans for keeping the people safe and also the physical structures, that we were able to get everybody out and also maintain as many of the physical structures as possible. And that site reopened on October the 1st. So I think this is a very important part, and we will continue to take it very seriously.
Thanks for sharing that. Can I ask for, thanks, some more time. So on CPP side, similarly, how are you tracking climate change risks, and has it really changed your investment portfolio in terms of measuring these different weather patterns and what it has done to different, to your real estate portfolio?
Yeah, I think it would be very similar to what you said. We kind of break it up into decarb versus physical. A lot of our focus for the last decade has been on the decarb side, and there's frameworks in place, and we take it very seriously. I think we're trying to be methodical in terms of we have a massive portfolio. Where is the low-hanging fruit? Where do we focus first to have the greatest impact, and then take it from a step-by-step basis? But what's really accelerated recently is the physical risk side that, I think that was a number 2, but now it's like 1A type of thing. And a lot of it is, there's a lot of historical data and modeling of something that's, 1 in 100, a lot of the floods and hurricanes, et cetera. And it's starting to become more 1 in 75 years, 1 in 50 years, 1 in 25. So as historical no longer becomes future, then we start to get really proactive in terms of if we're, for example, doing single-family rental investing on a coastal market that has a lot of exposure to hurricanes and flooding, et cetera, like what does that mean in terms of it's a large portfolio of multi-assets of asset risk. Maybe it's not the entire portfolio, but it could be 10%, 15%. So we're actively putting that into our pro formas now, maybe not as the base case, but as a case to think about as a 1 in 50 years or whatnot. What does that look like? And that's part of the decision-making process.
I did promise to go back to data centers. I have one more question. Yes, okay. Because a $15 billion investment with Singaporean sovereign wealth, GIC, together with Equinox, is a big deal. I'm just curious, because we're seeing a blurring of the lines between infrastructure and real estate. How do you underwrite this asset? What's the due diligence process? Is it an infrastructure play? Is it a real estate play? Is it a tech play? Is it an energy play? Like, what goes on in terms of the underwriting for such a niche asset?
So interestingly, and I think a lot more and more of the firms are arriving at this decision, it's a co-underwrite. So it's actually a joint effort between our infra and real estate teams, and we kind of play on where each group has their competitive advantage. So maybe real estate, if it's a development and we understand development, how development works, how the build out works, how lease terms work, and infra more so on how the contracts work, right? And I think the next evolution will be as power becomes more important, where does our energy team come into play into procuring that? So we have something that we call like one fund, and it's really to take advantage of the fact that we have all these capabilities. They might operate in silos, but how do we bring that together? And a lot of that operates in alternative asset classes. For us, it's not that alternative anymore. They're very important asset classes for us. And earlier I said best risk-adjusted return, and the way we think we can get that is not by doing what everyone else is doing and buying what we bought before, but really being creative, rolling up our sleeves where there may be a little bit of gaps in data, information, piecing that together ourselves and seeing something that maybe others aren't.
Blurring of the lines. So thank you so much to the panelists for your insightful comments. I'm sure there's going to be a lot of other discussions that happen after this session. So thanks again for your time and your energy and your insights.
Thank you, Fred. Thank you, Veronica, Janet, Puyan, and Peter. That was super interesting, as always. And as we've been playing around with the format of this program, last year we went, some of you will recall, half day over lunch just to give us more time, and that seemed too long, and so we've dialed it back to a mid-morning format, and sometimes it feels that we just don't give ourselves enough time to fully unpack because there's so much. But again, I really do commend you to reading the report fully this year, especially. We're turning now to, and I'm looking to my team just to make sure our furniture is set up, to the final segment to bring us home on our 20th Anniversary Trends program with a special Fireside Chat wrap-up featuring ULI Toronto's Chair, Salima Rawji, President and Chief Executive Officer of York University Development Corporation, who will be interviewing Salvatore Iacono, President and Chief Executive Officer of Cadillac Fairview. As we just get ourselves organized here with our chairs, I will invite Sal and Salima to take the stage and bring us home, and we'll have you all out promptly no later than 10:30.
Hi.
Hi.
How are you?
I'm good.
That was a lot that we
We're
heard
the
this
we're the
morning.
we're the closing act,
We,
right?
we
So-
lost a lot of people,
That's
so
right.
we got to keep them here now.
Okay, good.
So we got to have some fun, guys. I'm actually really excited to be here with you today. I am a transplant from Vancouver, and Cadillac Fairview Properties were some of my homes when I first got here, just trying to understand the city. And so I know every single person in this room has touched your real estate, been in your real estate, but can you just give us a 30-second rundown so that we all understand the scale of your operation?
Absolutely. Look, Cadillac Fairview has been a large presence on the commercial real estate scene in Canada for decades. In its most recent incarnation, I guess starting in 2000, Cadillac Fairview had been privatized by our current 100% shareholder, which is Ontario Teachers Pension Plan. And since then has basically focused on both office and retail. In terms of office, it's Central Business District, office towers. We're the largest office property owner and operator in downtown Toronto, have been so also in Vancouver. On the retail side, obviously, we're very well known for being a major presence with our enclosed mall business, of which we have 17 now across the country. But we've also been known historically and currently as being very active developers. So both on office and our retail assets, but also in terms of condominium towers over the last 15 years. In fact, when I joined Cadillac, it was because I was in charge of developing our condo projects in downtown Montreal. So, and going forwards, we're going to become more active investors in Canada.
Thank you. Thank you, Sal, coming from the development side and then I guess into the operating side and now running the firm. Amazing. So as you look to 2025, what are the things that pop up as priorities for you, the one or two things that you're going to focus your business on?
So I'll start off by describing that as of January 1st this year, so it's almost a full year now, Cadillac Fairview in Canada is now a Canada-only company. Prior to that, we also had all of our international assets. And the company, prior to this restructuring, was basically trying to conclude its diversification in its portfolio through exposure into non-office and non-retail asset classes, primarily outside of Canada. Fast forward, we're a Canada-only company now. So the priority for us is to start diversifying within Canada. So we want to add multifamily rental, we want to add the industrial, along with the great assets that we have in retail and office. So first, foremost, we continue to operate very successfully. We have 35 million square feet of space in Canada. We're a big player. It's a lot of work. For those of you who are involved on the operating side of the business, it's a daily necessary effort in order to maintain constancy and success in maintaining occupancy levels, driving growth through leasing, and most importantly, meeting all of your clients' objectives. And I won't use the word end user, but they are our clients. But you know, we have a lot of stakeholders in our assets, right? It's not just about our tenants, but it's about our shoppers. It's about the people who have a stake in the presence that we have in different communities and different parts of downtowns across the country. The other priority for us is, I mentioned that we're now going to start becoming more active investors. So that's a reflex that we have to start developing internally, which we have started with the hiring of Marco Ding, who's now our new EVP of Investments, who was formerly from CPP, which I believe,
We lost Janet, are you here?
Janet's
Sorry,
still
Janet.
here, so she probably misses Marco. But so these are the things that we are focusing on, that I'm focusing on.
Sal, thank you. So maybe we can dig into some of that. You talked about diversifying in Canada. You're talking about new asset classes. Which ones? You mentioned some, but can you kind of get into it a little bit more? And why now? What is the timing now on this decision?
It's a great question. So look, let me start off on the retail side. If you think about our vast retail portfolio, we have always driven an incredibly successful results from our retail. What I love about retail, what everybody in this room should know about retail, is that if you have great assets like we do, you really do have the ability on an annual basis to look at your client's sales and say, oh, by the way, your sales went up 10%. I feel like I can get a little bit more rent. Like, there's not a lot of other asset classes where you could do that and have those negotiations and be successful at it. So it's always driven a lot of growth up to the pandemic. Then the pandemic happened, and there were a couple mornings when I would wake up back in April or May of 2020 and say, holy cow, this is a bit of an existential question. Like, is physical bricks and mortar retail going to survive? And sort of fast forward, retail now has never been historically better for us. But we should also take a lesson from that and say, when 2/3 of your portfolio is in retail and you've just come through basically a near-death experience and you are back at full health, take advantage of that. Take advantage of rethinking what your portfolio makeup should look like. And with the full support of our shareholder, we are now looking at diversifying and releasing some of the equity that we have in some of our retail assets, having come through the experience that we've come through, and say, you know what? We should have more multifamily rental because currently we don't have any. And what we've done over the last year, we've launched no less than 3 multifamily development projects. And I come back to something that's been incredibly important in Cadillac Fairview's history. So maybe the most recent generation of people who are in this room don't realize that Cadillac Fairview from the early 1970s until the mid-80s was one of the most prolific multifamily and condominium developers in this country. And we're going to start going back to those roots through our development program. So we've got one 500-unit project underway in downtown Montreal. We're going to have a groundbreaking ceremony this upcoming Monday morning in Laval for close to 300 units. We're in the middle of construction on another 300 units in Ottawa, currently in downtown Ottawa. And what that will do is it'll help us diversify, as I was describing, but also it's going to bring some incredible benefits to some of the shopping centers, or to the shopping centers on which we're densifying, where we're building those projects, because it's going to be a virtuous circle. We're going to bring some great clients to the retailers, and the retailers and the properties and the surrounding areas, because they're really well-established parts of urban Canada, is going to provide some incredible amenities to those tenants. And along with that, we're also going to be, looking at acquisitions of multifamily in order to bolster that portfolio, because we want to grow it as quickly as we can.
On sites you do not own, so not development sites, you're going to buy existing multifamily
We
assets.
will buy, our intention is to buy also some existing multifamily if we can get the right product at the right price. Obviously, we look forward to doing that. And also the same thing on industrial. So on industrial, we're currently developing one site here on the 404, but I think the economics for industrial development are a little bit challenging right now. There's probably some better deals on the acquisition side, so we're starting to build that reflex and starting to underwrite some potential transactions. So there'll be more news on that, and there'll be more news on the multifamily front over the next year.
I have so many questions from what you just said, but we also only have about 10 minutes because Richard gave me the big talk about ending on time. So I'm going to jump forward, and then maybe we'll come back to some of this stuff. Sure. Did anyone say anything that you didn't like or disagree with?
Yeah, the sentiment regarding Calgary, not if you're an office owner in Calgary. And by the way, there's some great opportunities for buyers, but if you're the seller of an office building in Calgary, it sucks. It really sucks.
Congrats to CBRE for your deals, but the landlords weren't happy.
Look, to be honest with you, that's the only controversial thing of what I heard. On the office side in Calgary, it's still very difficult. I can share that on the retail side, we're the proud owners of and operators of Chinook Mall and Market Mall. It's evident that the economy in Alberta has been on fire. people have been incredibly well employed. There's been net in-migration into the province. It's reflected in retail sales. We have done extraordinarily well there. Having said that, downtown office in Calgary is still very difficult. There's still a high enough vacancy rate that if you think about, whether it's 10 million feet or 11 or 12 million feet, which is off of a high of 15 million feet of vacancy, think about on a historical basis, what was the year where there was the highest absorption of office in Calgary? Call it 1.5 million feet. There's 7 to 10 years worth of supply still ahead of you. So you're going to have to be competing with that. Oh, and by the way, the oil and gas industry in Calgary is being super smart with their money and super smart with their resources. And there's probably further wave of consolidation. So you've got two things to look forward to. Will there be a diversification of the economy for non-oil and gas players who are going to take up a lot of office space? And secondly, will there be enough of a pace for conversion of existing older office buildings that you can take out the denominator with regards to vacancy rates? And you have to place your bets on that.
So you said oil and gas a lot, so I just think we're in the midst of COP29, so I kind of want to ask about that. But I also want to ask about the diversification in your portfolio and how you're making the decisions about what you're divesting.
Right. So look, I think like any real estate owner, you love all your children. You want to keep your portfolio completely intact, but you have, even we at Cadillac Fairview have limited resources. Our shareholder is incredibly satisfied with us and their exposure to Canadian real estate as part of an overall global real estate portfolio. But there's only so much Canadian real estate that you can have. So we're having to recycle equity from existing assets, and we are going through our portfolio currently and assessing which assets are non-core. So I mentioned we've sold 2 smaller office buildings in Calgary. We just a week and a half ago sold an enclosed mall in Moncton, New Brunswick called the Champlain Mall. And we're going to continue some of those non-core sales over the next couple of years so that we can redeploy that equity into the multifamily and into industrial.
Is core NOI? Is core return? What is core?
Core in our assessment would be in part if a property, if it feels that in our hands that we've maximized the growth prospects for it in terms of NOI, whether we are a big enough player in a market or not, and if we're not a big enough player in a market, then are we better off focusing our efforts on other assets? And where, from a management perspective, where are my team members best putting their time and resources in terms of next year's budget? Where can I drive the most growth? Yeah. So, Toronto Eaton Centre, I'll use as an example that we own 100% of. Like, we can drive growth in the millions of dollars on an annual basis. And on a smaller asset somewhere in the country, to get $500,000 worth of growth, it's a lot of heavy lifting. So where do I want my team to focus on? It doesn't make that smaller property not a good property. It's just going to be no longer for us going forwards.
Thank you. That is, as someone who is learning to run a company, like just such insight from a leadership perspective, I really appreciate that candor. Can we talk about the fact that we're in COP29? We had a conversation about ESG. Here, the investors on the stage said it was something really important. I think it's really hard to execute on. What are you guys doing?
Well, we're doing as much as any commercial real estate company can do here in Canada. First off, I wouldn't have my job if I wasn't, and the rest of my team, not focusing on this, because we're owned by Teachers' Pension Plan, and this is an incredibly important part of what they do. Investing in operating companies who are also very sensitive to all aspects of sustainability practices. So that's ingrained in us, first. Secondly, it's really good business, because if I think about, for example, in my office business, we have over half of the entirety of our office space is occupied by the top 15 corporate who's who in Canada. Do you think that when we sit down for a lease negotiation, certainly over the last 5 years, that this issue does not come up? It absolutely does. And not only does it just come up, but it's starting to become part of the deal-making process in terms of what are you prepared to step up as a landlord and deliver in terms of reporting, in terms of emissions reductions, and so on and so forth, because it's a partnership. And that partnership is required because they, on their side, have to report on that to their boards and to their clients. So this is becoming an incredibly intricate web of relationships and commitments and focus. The other thing that I would say, too, with regards to this is that we've done a really good job of making the right investments in reducing emissions and trying to meet our targets, and along the lines of trying to respect science-based targets over time. And there's some dispute whether it's going to be 1.5 degrees by 2030 or 2 degrees, and those nuances are very important because it drives the amount of capital that you have to focus on it. But as an industry, the thing that I'm most concerned about, and that everybody in this room should be concerned about, is the simple fact that even with all the technology that we have, whether you use AI-based energy management platforms or simple changing of to LED lamps and whatever it is that's low-hanging fruit, ultimately we will all hit a wall. In order to be able to meet zero carbon, we're going to have to do fuel switching. There's just no amount of natural gas or super efficient systems with any kind of carbon system short of electricity. And even then, electricity then is going to be in such high demand because of all the data centers and everything else that is going to be built. And it's going to be at 2 or 3 times the cost of, call it, carbon-based energy. So as an industry and as an occupant, we're all going to have to come to an agreement that if this is really important to us as human beings, then we're just going to have to pay in order for us to get to this. And by the way, not only will we have to pay, but we're also going to have to push the governments or the hydro utilities or whoever is in the position of deciding on these things to ensure that the source of that energy, of that electrical energy, is also clean. Because it does us no good to have a coal-fired plant or some other natural gas plant at the other end of that electricity generation. So we're going to have to collectively have to deal with this, but it's going to cost us. It's going to cost everyone.
Thank you again for your candor on that. And I'm sure those of us working on this issue are running into that exact commentary around how much electricity is actually available. I have time for one more question. I have like 18 questions on my page. So you told us about your priorities for 2025, but what are the bright spots? Maybe not your priorities, but what are the things that kind of bring light, or as your kind of final words to the stage for 2025, what are you most excited about?
Well, I'm most excited about our retail business. I think the Canadian consumer is still in pretty good shape. If I could describe the sales numbers, starting in July, August seem to have been plateauing, but not drop, which is a really good positive sign given where interest rates have kicked up and the time lag that it takes. There's some really positive signs from our retailers. They're still very much interested in continuing to do business with us and expanding with us. Really good positive releasing spreads on that. I'm really excited about our multifamily business and growing that, and I look forward to some better, I think our development team certainly would look forward to some better construction pricing, which probably will happen over the next 12 months as the last spate of condo projects are being delivered, and all the subtrades are looking forward and saying, holy cow, what am I going to be doing for the next 12 to 24 months? So it may be an opportune time to take advantage of that pricing before things start ramping up again. And, it's not something that I look forward to, but, for those of you who are exposed to office, I've been in the office business for a long time. And the best thing I could say is that this too shall pass. Not if you're a suburban office owner, but also.
It's not you, so that's okay.
And I have been that, and I've lived through that. But you know, if I could share my experiences of, you know, history doesn't repeat, but it rhymes. Back in the 90s, when I was, you know, working at Trizec and Marathon Realty, well, I'll use one example. I still remember having a pro forma for a 1 million square foot office building in downtown Montreal, and my net effective rates started at $32, and then they ended up at -7. And we didn't have a pandemic, we didn't have return to office issues, et cetera. If I compare that to today, you know, is there a downcast mood with regards to office? Yes. Is vacancy up? Yes. But you know what? We're still talking to tenants. We're not having to do lease takeovers. We haven't done a negative net effective rate deal. In fact, you know, I would say that generally speaking, what we have to recall is that right before the pandemic, we were in an unnaturally buoyant state. We had less than 2% of vacancy rate in Toronto and Vancouver, and everybody thought that in Toronto we were going to go from mid to high 40 net effective rates to 70 to 80, and finally we were going to start rivaling London and New York. Well, it didn't happen. But today's net effective rates are in the mid 30s, high 30s, high 20s, depending on your location and the quality of your building. It's not death. What is hard is that, you know, the appraisal community, the liquidity, financing availability, that's tough. But for those who can, you know, get through this stretch, there is some leasing activity that's happening in terms of touring activity. There's a lot more employers today than there was a year ago, there was 2 years ago, who are mandating their employees to get back. So there's going to be a better mood about things over the next year or two. There's still growth in Canada. It's going to drive occupancy. Occupancy is going to be driven by GDP growth, by return to office. So we're going to have to wait it out. We've lived through this before. We'll live it through again.
Thank you so much. This too will pass, and let's go shopping. Yeah? All right.
Excellent. Thank you.
Sal and Salima, thank you very much for that. And I think you've echoed or rhymed with some of the points that were made earlier. I know Peter said you feel better this time this year than this time last year, and I think that's a sentiment that we heard even in these challenging times. So I want to thank all our speakers. I mentioned Peter, Poyan, Janet, Veronica, and Fred and Frank. Just a great pleasure as always to work with your team on the event, and obviously this stellar report that is like no other, that really gets us into some qualitative detail that I don't think any other report can touch, and it's just a great honor to be a partner to help you present this report and every year. So thank you to PwC. Thank you to all our table sponsors, so many. We had to move rooms actually to accommodate you all, which is a great sign as well. So thank you. And with that, on time, as we promise, as always, we'll see you next year, but hopefully at an event sooner than that. Good night.